Question 1. Carolina Ochoa, CFA, is the Chief Officer at Patagonia Computing. Ochoa is currently the subject of an inquiry by Patagonia's Corporate Investigations Department. The inquiry is the result of an anonymous complaint accusing Ochoa of falsifying travel expenses for senior management related to a government contract. According to the CFA Institute of Ethics and Standards of Professional Conduct, it is most appropriate for Ochoa to disclose the allegations A. to CFA Institute when the investigation concludes, B. on her professional conduct statement, C. to CFA Institute if the allegations are proven correct. Members and candidates must self-disclose on the annual professional conduct statements all matters that question their professional conduct, such as involvement in civil litigation or criminal investigations, or being the subject of a written complaint. The answer is B. Question 2. Lena Inkster, CFA, was recently offered a senior management position within the trust department at a regional bank. The department is new, but the bank has plans to expand it significantly over the next few months. Inkster has been told she will be expected to help grow the client base of the trust department. She is informed that the trust department plans to conduct educational seminars and pursue the attendees as new clients. Inkster notices that recent seminar advertisements prepared by the bank's marketing department do not mention investment products will be for sale at the seminar. The ads indicate attendees can learn how to immediately add $100,000 to their net worth. What should Inkster most likely do to avoid violating any CFA Institute standards of professional conduct? A. Decline to accept the new position. B. Accept the position and inform senior management of inadequate compliance procedures. C. Accept the position and revise the marketing material. The prospective supervisor's first step should be to not take the position. Accepting the position with inadequate procedures in place or improper marketing material would leave Inkster at risk of incurring a violation of Standard 4C, responsibilities of supervisors. She could agree to be hired as an interim consultant with the bank in order to implement adequate procedures before taking on any supervisory role. The answer is A. Question 3. Beth Kozniak, a CFA candidate, is an independent licensed real estate broker and a well-known property investor. She is currently brokering the sale of a commercial property on behalf of a client in financial distress. If the client's building is not sold within 30 days, he will lose the building to the bank. A year earlier, another client of Kozniak's had expressed interest in purchasing this same property. However, she is unable to contact this client, and she has not discovered any other potential buyers. Given her distressed client's limited time frame, Kozniak purchases the property herself and forgoes any sales commission. 6 months later, she sells the property for a nice profit to the client who had earlier expressed interest in the property. Has Kosniak most likely violated the CFA Institute standard of professional conduct? A. No. B. Yes. She did not disclose her potential conflicts of interest to either client. C. Yes. She profited on the real estate to the detriment of her financially stressed client. Kosniak does not appear to have violated any CFA Institute standard of professional conduct because she is known in the market for investing and brokering property, and both parties have worked with Kosniak in the past. Both parties would know of her interest. In addition, in both cases, she acts for her own account as a primary investor, not as a broker. She buys the property for her own portfolio and then sells the property from her own portfolio. Therefore, Kosniak did not violate Standard 6A, disclosure of conflicts. When she purchased the property for her portfolio, she saved her client from losing the building to the bank and did not charge a sales commission because the sale of the property to her other clients did not take place until 6 months after her purchase, and she was unable to contact the client who had earlier expressed interest prior to her purchase. She cannot be accused of violating Standards 3A, loyalty, prudence, and care with either client. The answer is A. Question 4. Mariam Musa, CFA, Head of Compliance at Danfield Brokers, questions her colleague Omar Kasim, a CFA candidate and a research analyst, about his purchase of shares in a company for his own account immediately before he publishes a buy recommendation. He defends his actions by stating he has done nothing wrong because Danfield does not have any personal trading policies in place. The CFA Institute standards of professional conduct were most likely violated by A. Only Kasim, B. Both Musa and Kasim, C. Only Musa. Both Musa and Kasim violated the standard of professional conduct. Musa violated Standard 4C, responsibilities of supervisors, by not ensuring policies were in place to prevent violations of the standards of professional conduct. In this case, Standard 6B, priority of transactions, by someone subject to her supervision. As the head of compliance, Musa supervised Kasim and must meet her supervisory responsibilities outlined in the Standard of Professional Conduct. Kasim violated Standards 6B, priority of transactions, because he did not give sufficient priority to Danfield clients before trading on his recommendation. The answer is B. Question 5. Which of the following statements does not accurately represent the objectives of global investment performance standards? The GIPS standard A. Ensure consistent, accurate investment performance data in the areas of reporting, records, marketing, and presentations. B. Obtain global acceptance of calculation and presentation standards in a fair, comparable format with full disclosure. C. Promote fair competition among investment management firms in all markets by requiring common fee structures. One of the objectives of the GIPS standards is to promote fair competition among investment management firms in all markets. This objective does not require unnecessary entry barriers or hurdles for new firms, such as common fee structures. The answer is C.